I know I'm not supposed to play favorites, but this is my favorite panel of the day. All right, let's dive into regulation and tokens. So what's the problem? What is the panic about? Why is the SEC all excited about what we are doing here?
So I'll take that.
Yes.
I think it's important to understand where the SEC is coming from, what their motivation is, what they're worried about, and I think what drives them is essentially not being called in front of Congress. The absolute worst nightmare for them is a hearing in front of Congress where some constituent of some congressperson has lost money in some kind of token scam, and they're being grilled for that. So they're trying to avoid that scenario, and that's where they start from. So essentially, they're playing defense. The challenge that we have had as advocates for this emerging economy is to explain to them all of the upside that comes from this economy.
So, Brad, for the SEC, they're playing defense. They played offense by raising their hand and saying, hey, we're in charge, right? And they did that mid-last year when they issued the Dow report and said, we have jurisdiction over investment contracts, and we feel the Dow was investment contract, therefore a security, we have jurisdiction. Then they went radio silent. And for the next 6 months, the securities bar interpreted that to mean, hey, we had no problem with the Dow being characterized as a security, but we felt that the token offerings that people were involved in, where networks had functionality, that the tokens had a use, that did not constitute a security, and therefore no jurisdiction by the SEC. The SEC suddenly chimes in December. And then that leads us to our, next journey that we've all been involved in dealing with the SEC and trying to rationalize securities laws with what is actually going on in this, what I view as revolutionary technology and the need for cryptocurrency.
Just for context, this panel, these people here on the panel have been talking to the SEC face-to-face in the past at least couple of months that I know of. So what they are talking about is from direct experience, and that's what makes this panel very special. Lowell, you were going to say something?
I was going to pile on. I think it's really important to set the context here of why we have securities laws in the first place, or at least why they were originally created. This interesting social debate has started probably with Facebook when it was a private company and everybody wanted it in, and it was so unfair that only the venture capitalists got rich on Facebook. But we have to remember, and we hear this always at these conferences, that we want everybody to participate. But the whole point of the securities laws was to combat this notion of everybody participates, because we had this crazy experience in the Roaring 20s that led to the Great Depression in the 30s, where everybody was getting rich on the stock market. Literally the securities laws, the 33 Act, is intended to exclude the moms and pops from, too risky of an investment. And so this notion that everybody should participate is extremely naive in the context of why we have securities laws in the first place. So that's the starting point. That's what we're trying to push back. But again, we've had crowdfunding rules. We've had sort of chipping away at this notion over time, based on largely probably Facebook, when we really started to have this new discussion about whether we should have more people participating in capital formation.
And also to add, all of the communication we've received or limited guidance from the SEC from the enforcement side or proactive guidance stems from the fact that the SEC doesn't yet know where and how to act in this space. And that's part of our industry effort, is to have that open communication with them, propose suggested ways that they could allow this technology to continue to thrive within the existing securities laws, but also know there's certain ways that there must be flexibility in the regulations to allow the tokens and the technology to continue to function.
I think you're being very kind. What we're doing primarily is educating the SEC on what blockchain technology is, how cryptocurrency is utilized in that technology, because I think there was just a misunderstanding by them as to what cryptocurrency is all about. They hear cryptocurrency and they see fraud. And what we see is it's moving the technology. And I think that's where Brad came in and made an incredibly effective presentation in one of the days that we met with a variety of people at the commission as well as the CFTC. And so we got to hear the presentation at least 6 times that day. But it was so effective, and you could see light bulbs going on in their heads as to, oh, gee, we didn't really quite grasp that concept.
Brad, so do you mind giving us a summary of what you told them?
So basically we were arguing for the re-decentralization of the web, and we were pointing out that we're living in an era of very rapid consolidation around Google, Apple, Facebook, Amazon, and that competing with those, what I will call data monopolies, is not really possible by offering a better service. We actually saw this movie in the mid-90s when Microsoft consolidated the entire PC software industry. And IBM tried to compete with Microsoft by offering a better operating system called OS/2 and failed miserably. What ultimately undid Microsoft's hegemony in the mid-90s was a shift in venue from the desktop to the web, and a shift in business model from packaged software to open source. It was really impossible for Microsoft to open source Windows given how much they had invested in their existing business model and their distribution channels. So the only way that one can expect to compete with these dominant data monopolies is by changing the game, by changing the way the market works. And so if we think of the internet as an open public communications medium that fundamentally altered the way media, the entire media industry works, blockchains are open public data stores. The thing that Google, Apple, Facebook, Amazon will not be able to do is open up their data sets. And so the argument that we made to the SEC is that this is the next wave of technology. If we're going to open the market for another wave of innovation, for emergent, bottom-up startup innovation, the only possibility we have is to change the game, and this is the best chance we have. That's the argument that we try to make.
So what are some of the solutions that you are suggesting to them in terms of making this better for the market?
Well, maybe, William, I'm sorry to usurp your role here, but I want to hear Brad say, because the first question we get asked by the SEC, before we get into solutions, we're focusing on the problem. Why can't this just be a security? Why can't we regulate this as a security? What's the problem with that? And we heard 2 panels ago from a group of brilliant folks who are building these digital securities platforms. Why isn't that enough?
The challenge there is, we had a lot of conversations about whether or not something could start as a security and become something else, and then where to draw that line. And the real challenge is that we are envisioning a world where you end up with networks interacting with each other, so that if you think about a software stack and you think about what the ultimate decentralized stack will look like, there's going to be, at the foundational layer, there'll be compute services and file storage services and, caches and all sorts of services that are assembled to create a single user experience. And you can imagine a world where tokens are being exchanged in nanoseconds, millions of times a second. And you can't do that in a world where every single one of those tokens has to be registered, has to comply with securities laws. You can't have that kind of fluidity in a software stack. So that's one of the key arguments that we made. The other argument, just real quickly, is that if you imagine a decentralized application, let's just say a decentralized Uber for now. There are a couple of things that you lose if you define these, you define the token that mediates that network as a security. The first thing you lose is the ability for the creators and consumers of values, think of it as the drivers and passengers in this case, from participating in the appreciation as that network gains in value. Because if you exclude them, as Lowell says, which was the original intent of the securities law, then you're basically carving out a big chunk of the value of the appreciation for them. The second thing you lose is the ability for a secondary market to allow those creators and consumers of value to trade in and out of that network. So it's fine if they want to participate in that network, they want to, hang on to that token, they want to stake that token in some way. But at some point, they probably have to buy milk for their family. And so they have to be able to trade in and out of that network. So the big sticking point, and the one that's really been difficult to deal with, is how do you handle a secondary market? Even if you define the early existence of a token prior to the availability of a network as a security, unless it somehow transforms into something else, you can't possibly actually have these layers of value interacting with each other, and you don't have a secondary market that allows the participants to trade in and out of it.
I just wanted, that I think is really what tees up the solution. That's the problem we're trying to solve, is allowing people to use tokens for their intended purpose in a network as a non-security, and allowing a secondary market for that to establish the price so that it has a value and can be used as an exchange of value, underneath the hood of some really futuristic blockchain-enabled application. And that I think is really, honestly, that tees up what we are trying to do with the SEC as a solution, because we're trying to get there with, creating a very novel approach to this, where we essentially carve out use case and secondary markets, but put some bells and whistles of investor protections into the process of capital raising, because these tokens are being used for both purposes, and that's a really strange animal from an SEC perspective. And novel is a bad word in DC, so we're fighting a very uphill battle. But
so you can see the safe harbor proposal that we put into the SEC. It was all supposed to be confidential, and it got leaked, as well as a memo from Lowell's firm, which is an excellent memorandum on why tokens should not be securities. But so it got leaked, and that's why we feel pretty confident about talking about the conversations we've been having with the SEC. And the thing is, there is a role for government. There is fraud going on. My wish is that the SEC would actually focus on the fraud cases rather than focusing on companies who did a token offering where there's utility in that token, may not be the full functionality that we're all kind of singing from the same hymn book right now. But the SEC's point of investor protection, disclosure takes care of everything. Well, disclosure doesn't take care of everything, in my view. And I was a former staffer at the SEC. I think I'm the only one on the panel, right? Former. So I can criticize them as much as I want. The dot-com boom, we had more than enough disclosure out there, yet that didn't stop the chaos that we had in 2001, 2002, didn't stop the crisis, the financial crisis in 2008. So disclosure's not the only answer. Again, my hope is that Congress would act, that we need a new regulatory agency who would come in with a lighter touch to regulation, that they're not stuck with the baggage of the 33 Act, the 34 Act, and that the agency has an understanding of what blockchain technology can do. And we are only talking about one jurisdiction. Keep in mind that, these offerings are global now. I had a client, they did a public token sale, and it went into 102 countries. And, you have to be concerned not just about the U.S. and what we're doing, but you do have to be cognizant of what other countries are doing. And there are efforts, starting in virtually every country.
So, Ness, are you implying that the current regulators cannot innovate? That's why we need a new agency that can kind of cross all that and be more friendly to what the market wants?
See, that's my hope. Right now, when we look at any company wanting to do a token offering, and I think all of us as lawyers have kind of stopped that process. We do pre-sales so you can develop your network, but what you have to be concerned about is we have at least 5 agencies you have to be worried about. It's not just the SEC, it's the CFTC, it's the FTC, it's the Department of Treasury. You have to worry about FinCEN, money service provider registrations. Then you have the 50 states. If you happen to touch money transmitter issues, we're a very fragmented regulatory system at this point. I would like it under one agency, and a smart agency. What we have is, for example, with the SEC, they come in with a little box and they say, okay, here's our box of regulations, and this is, you have to fit in it. And we're going, well, no, we're kind of really outside the box. And no, this is our box, you tell us how you fit in it. And they don't have answers at this point. And so we're trying to guide the thinking, we're trying to educate, not just the SEC, but the other agencies. We have to be concerned about Congress because they're taking an interest in this. I do find that the Democrats seem to be less inclined to be more flexible with respect to cryptocurrency, which I found kind of surprising myself. But and if there's a shift in our Congress as a result of the midterm elections, I think that hill just got really much higher. But we keep working at it. We need a solution. To me, this is either we keep innovation in the U.S. or we move it offshore. And what the Commission has said to us in our conversations is, look, we don't want that happening. We want to get a solution, and I think they were actually fairly open-minded in our conversations with them, other than the chairman, who has, I don't know, his belief is everything's a security, it stays a security, and, move on from that.
I just wanted to discuss a little bit about this box in which these blockchains are trying to fit into now as a security from a legal perspective. The counter side of Brad's challenges from an operational perspective is that currently, if a token is viewed as a security on a blockchain, in order for it to comply with the securities laws, every time there's a movement of the token among two parties, peer-to-peer, that's a securities transaction. So the entity designing that blockchain, the issuer, or some other participants have to be registered as a broker or dealer, be responsible for trade reporting, comply with capital requirements, all of the securities laws that apply to a traditional financial services company, and will vary based on federal, state, local requirements for each of those. And it's just not feasible to do so for blockchain companies. And that's part of the education and relief that we're seeking, that tokens that may be sold in a manner that complies with securities laws don't necessarily need to be securities when they're used on a blockchain, which is a little different than the regulation of digital asset exchanges, where the SEC has also been very active and trying to push for more registered entities in that space. People buying and trading securities on those markets may need to be regulated. So, trying to educate them on that distinction and where the current securities laws may be more appropriate from a regulatory perspective.
You know, as one of two non-lawyers up here on the stage, I don't know, William, you're not a lawyer, right? Okay, as one of two non-lawyers, I wonder if we could offer some advice, you know, some practical advice. You know, these folks out here are not going to stop what they're doing, wait for clarity. So how would we suggest to them that they, you know, not be a target? Let's assume that there is no clarity. They want to move forward. How do they do the best job they can of staying under the radar and building a business while the SEC is figuring this out?
I guess I'll just start with a quick thought, is that the industry is coming up with a lot of self-regulatory best practices, and those are good guidelines to follow and try to stay ahead of. A good example is doing AML KYC on purchasers. There may not be technical requirements to comply depending on the type of entity, but that's best practice that is developed over time and maybe something to consider.
Yeah, I mean, and this is where I think Nancy's point about a new agency is a good one, but it's a very long-term solution. I still see a perfectly fine path through the existing regulatory regime, but you do have to get it right. And so for me, the current model, based on 2017, the SEC was saying, hey, there's no bright lines ever going to be published. We're not going to do no action letters. We're not going to do rulemaking. It's facts and circumstances. It's case by case. Some token sales are good, some are bad. Ask a lawyer. That was the position from the Dow report. Now we have a situation where there are going to be bright lines potentially coming out of the process that we're all working on together. And that's a very different risk calculus as somebody in this market. But the interesting thing I think that we've hopefully established, it appears that we've established through the initial discussions at least, we've seen a very interesting change in the concept of mutability, which was in question in 2017. This idea that a token, the same token, could be a security for purposes of pre-functionality and a non-security at some point later when the circumstances change and it's no longer a security because it has full functionality or perhaps full decentralization, but there's a trigger point at which it becomes a non-security. That leads to a good model, which is you could sell to accredited investors only initially and be bulletproof for now with that first step. Wait to do any kind of second step, whether it's an airdrop or whether it's a sale to the general public. But any kind of delivery of the token into the wild where it starts trading as a non-security, before you take that step, you could wait for SEC guidance. You could wait for this process to unfold. You could therefore raise all the money you need to build your system through the traditional securities law exemption process. And then build, use the time between now and when we get something from the SEC to go build the crap out of your functionality.
Well, let's assume that the SEC takes longer than the software development effort to produce a protocol, and you get to a point where you have a protocol that's ready to be released in the wild. You've done a securities offering, you've done a registered securities offering, you've done AML KYC on a select group of investors, and now you have full functionality and you want to release the software to the wild. There is that step, and then there's the second step, which is once it's clear that there is full decentralization. One of the things that happened in all of these conversations is that pretty much everybody acknowledges that Bitcoin doesn't look like a security. I mean, they may, try and rope it in some way, but I think the key reason that everybody accepts that it's not is that there is no promoter. There's no Satoshi doesn't come out and offer much in the way of direction for the protocol, and so there's nobody really guiding that protocol or exercising control over that protocol. So a couple of things that you can think about. One is the issuance model when you do decide to release the tokens either in an airdrop or to somehow distribute tokens more broadly. If you are pre-mining 80% of the tokens or in some way controlling a very large portion of those tokens and essentially sitting on a lot of the financial value that might be created as the tokens appreciate, you're going to be looked at very carefully. If you are making sure that more of those tokens are in the hands of the creators and consumers of value in your network, I think you're in a better position. I think you're going to be bottom of the list when it comes to enforcement actions. If you have a governance model that allows for the network itself to participate in the choices that the network makes in terms of the future of the protocol, again, I think you're at the bottom of the list. So those are all things you can do, I think, to be a little bit more bulletproof.
So what would constitute a token being a utility? That's another discussion point. And when is a token a utility? Can it be born as a utility, or does it become a utility? So by default, it's difficult to be a utility at the beginning. So by default, everything is a security. And then that's what the SEC is trying to bring the conversation towards, no?
Well, the SEC is trying to bring the conversation to all tokens are securities. We're trying to change that narrative by saying, no, if it has utility within a network, you lose jurisdiction, as they say. So, again, just to add on with what Brad and Lowell and Lilya were saying, what does an entrepreneur do? You've raised all this money, you've developed your network, you think you're fully functional, but you want to take that next step. And if it's an airdrop, again, the SEC's view is that may constitute a distribution of a security. So what do you do? Or what do you do if you need to raise more money? At that point in time, if you're fully functional, we sit down with the SEC, and we're doing this with a number of clients, and we can talk about what the industry group is doing too on that front, but we're going in with a term sheet with the SEC. We figure, hey, let's bring them into Silicon Valley. We'll just do a term sheet. We tell them all the facts surrounding how we view full functionality and how this token's going to work, and we have that conversation with them. While we are not anticipating that the SEC will provide us any written guidance, they may give you a wink and a nod. They may say, yeah, you're not going to be on our list to refer to enforcement. And we may decide to go that next step, whatever that token generation event is ultimately. That's the only way right now that Cooley is willing to move forward on this. We get a lot of meetings with companies that have these schemes, I call them schemes, of trying to do a public token. They'll do a pre-sale in the US, they try to do a public token sale in some jurisdiction outside the US, and they're saying, oh yeah, we'll do AML, KYC, we'll forbid US investors, but that's not the end of the conversation. And I think somebody mentioned, you have one US investor, and that one US investor comes in and complains, the SEC is going to try to exert jurisdiction on you. I do agree that you may be lower on the list, but all you need is really some big mouth going in there and complaining, and they will open up an investigation. And these are not inexpensive things to go through. I co-opted this expression from somebody else in the public company context, but being involved in an investigation is like living in hell without dying. And you will be spending between $100,000 and $300,000 a month dealing with the SEC's requests for documents, requests for testimony. It is an expensive proposition. And, until this space is further developed, you really have to be very, very sensitive as to what steps you take.
We're very close to the end of the time. We could have talked for another half an hour. Just in closing, just short answers from each one of you. What do you hope to see in the next 6 months? What can we hope to see in terms of positive developments quickly?
From my perspective, I'm hoping there'll be more clarity and good use cases that the SEC will find as the right path to provide some type of limited relief for good projects, and those may be the basis for us to move forward with others.
Yeah, I think that's the number one thing is clarity, and probably, if I had my druthers, I'd like the clarity to be around this model that we've sort of proposed already, where there's maybe a few more investor protections needed for full functionality, less investor protections needed for full decentralization, based on the idea that full functionality is just a very hard, bright line to draw. Full decentralization is a little bit easier. But if we can get there on that kind of a model, that would be the clarity that I'd want.
I'd like to see effective jurisdictional competition. I'd like to see other jurisdictions around the world offering a very clear regime, and I'd like to see that putting pressure on U.S. jurisdictions to respond.
And I'll actually answer your real question. Nothing will change in the next 6 months, unfortunately. So,
on that note, thank you very much.